First of all, know yourself and what you want out of this. VC is not the only
Mhm.
avenue and not the only way to grow. So be super honest with yourself.
Hey everybody, welcome back to a SUBTA Studios Friday Live. I am your host, Chris George, co-founder and chairman of SUBTA, and today we got special guest Rachel Brink. Rachel, thanks so much for being on with us today.
Thank you. Excited to be here.
Great. So Rachel, you are the former founder and CMO of Scentbird. You were a partner at 5-4 Ventures, and now you're currently advising and investing in startups. Is that right?
Yep.
It's a nice resume there.
Thank you. Yeah. I always feel like it's one chapter and then the next and then the next. I'm always sort of thinking about what I can continue to learn and continue to develop.
Well, what I think is great is, Scentbird is such an amazing business, probably the leader in subscriptions for men and women's fragrances. And then you're able to take that knowledge and go to a VC firm, become a partner there, and now you're advising startups. So it's truly a great story and great to have you on because, today for everybody, we're going to talk about venture capital and what that can mean for your business. Rachel's going to tell us the things that she looks for when potentially working and investing with a brand. Also, understanding what it truly means, because we know that trying to raise money can be a full-time job. And then once you raise the money, what do you do with it, and several other things. So, Rachel, let's just start with the basics. Like, what does venture capital mean? And if for those that might not be that familiar, just tell me a little bit about that to start.
Sure. So venture capital is a very specific type of funding vehicle. Funds usually have allocated money that come from limited partners, and these allocated pools of money are there for them to deploy in acquiring pieces of companies. Now, the thing that you have to think about with venture capital from the investor perspective, and I think it's helpful for companies to understand, is that these are long-term capital, right? So the fund gets this money for about 10 years that they have the time to hold it. But there's a huge expectation that they are going to, at least for a venture capital fund to be considered successful, they have to at least 3x their money. So what that means is that the expectation when a venture capital firm decides to invest in your company is that you are going to basically triple your business at least.
Yeah.
And I would say that most, not all, but a lot of venture capital businesses are really looking at big bets, right? They're looking for truly scalable businesses. They're looking for, large exits, large markets, large opportunities to expand those businesses. So I think that's really important when you think about venture capital funding versus other types of funding, is that there is an expectation for fast growth and scale. On the other hand, it is a very viable type of funding for companies, but it has to be the right type of company.
And I know that, there are the benefits and drawbacks to VC funding. I've been in a situation where the businesses I built, I didn't have to raise any money, but there's times where I was like, well, what if I did? Could I accelerate the business? What does that mean? Tell me what you think some of the benefits are for those that want to raise venture capitalist money. And then also, what are some of the drawbacks, right? Because I know that you have a partner now that is expecting reports and takes up a lot of time. So tell me a little bit about that.
So I think that, first of all, and I will be the first one to tell you, I don't think venture capital is for every business. I think as a founder, you have to be brutally honest with yourself of what you want. I actually had coffee with a founder last week, and she was telling me, well, I want somebody who's going to put in money, do the work, and help me with distribution. But I want to control the business. And really, I think this business is something I could inherit to my son. And I was like, okay, lady, you are not looking for venture capital business. This is not what you're looking for. And I think, again, that's really important to know. I mean, for some of you, you are looking for a family lifestyle business that you can leave to your family. That's great. Venture capitalist is going to look for. And so, again, there are other ways to fund your business. There are other ways to grow your businesses that might be great for you. There are some startups that are famous for not having raised venture capital money. So taking a real hard look at your business and your objectives for that business is super important. So in terms of, what are the pros and the cons? So I think the most obvious pro is it takes money to make money, right? And so if you want to grow fast, this is a way to get a ton of money, a big injection of money into your business, into your cash flow. You're going to deploy that money and grow fast. Now, is you're losing control. What you're going to lose, you're going to get a partner that, to your point, is going to expect you to report on your results. They might have a seat on the board. They might control the board or not control the board, depending on how much money they're putting in. They might be able to fire you if they're not happy with the results. So there's, there is you're bringing in a partner into your business with all the pros and the cons. And, you two might not, and I think that's one of the things that's really important, is to do your due diligence on your end as a business to understand, like, some venture funds are growth at any cost. They just want you to burn through your money, grow really fast. And frankly, for them, they want you to go out and raise more money because that just lets them show,
More valuation.
mark up more valuation and mark up their books. So that you want for your business, right? You might be like, look, I don't want to dilute myself. I don't want to give up more of my business. I want to grow slow and steady. And so again, it allows you to grow fast. Again, I do believe, as it's funny because, thinking about my prior hat of having been a marketer, it takes money to do these things. I think there's such a aura of like, oh, we did it with nothing. Well, most people, it's really hard to do it with nothing. And usually if you're doing it with nothing, it takes a very long time.
Yeah.
So a reality of the trade-offs between, thinking about businesses that should take in money or shouldn't take in money.
Yeah. It's funny because I feel like it was just I feel like this sentiment has changed a little bit, but it was like 2-3 years ago. It was like whoever raised the most money was like the successful one, right? Like no one cared about profitability. Like they were like, you were in the valley and it was like, who raised 300 million and who raised 500 million. And like some of these valuations were insane on businesses that were not profitable. Have you seen a change in that? Has VC money not been as like easily flown out, right? What are you noticing?
So I think there's a lot of nuance. I think that valuations remain extremely high. I think it really varies by industry. I think, subscription is sort of an interesting one because I think there was sort of subscription 1.0, Birch boxes of the world, and that didn't turn out so well. But now you're seeing BarkBox is going public. And so there is, my view is subscription is absolutely a very viable business model. Recurring revenues are a beautiful thing. But there's a lot of very specific metrics that need to be met. And so, specifically when you think of, I agree with you. I think that this idea of only celebrating fundraise, like, no, celebrate sales, celebrate, performance, funding. It's neither good nor bad. It is what it is. If you need it to grow, you take it. If you don't need it, you don't take it. Right. So that's my view on the funding. But I think for subscription, there's been sort of this back and forth of, for some time it was very, very popular. Then it became, well, who's going to acquire these companies? Now we're seeing companies that are subscriptions that are able to be built out big enough that they can stand on their own. Ipsy is another example, right? So I think that there's a constant sort of flow in the market of how they're understanding subscription.
Yeah. And so when a firm is looking to invest in a subscription company, and I truly believe that, the recurring revenues clearly shown higher valuations than a typical e-commerce, right? So like you should be thinking about subscription. But what are the metrics outside of like who the founder is? What are the metrics within the business that a VC firm is looking at? And I also want to touch on to like, what does that look like pre-launch versus post, right? Because you don't have as much data pre-launch.
Yeah.
But let's say post-launch, they're in business, what are the metrics they're looking at when deciding whether or not they should even do the due diligence to invest, right? Because we know that it's a process.
Yeah. So I'm going to say exactly what you told me not to say, but I'm going to start with team. And I do think that particularly at the very sort of first touch point, a big part of it is they're going to meet you as a founder, and they're going to say, like, does this guy or gal have the guts, have the vision, have the grit to make this a large enough business that it can be venture backed? And so I do think there is a lot about the founder. There's a lot about, if you're a solo founder and that's it, a VC is going to think, well, does this person have the leadership, have the gravitas to bring people along with them? Because very hard to win this game by yourself. I think that the technological talent counts for a lot. So having a CTO being able to say, look, we're going to, we can build this ourselves. We are not entirely relying to outsourced tech talent. I think that can really differentiate you. So I think the team piece, super important. Do they understand the customer? Do they understand the market dynamics? Do they understand how to get customers from who are these people? That's going to be sort of the first layer of how they look at you. I think the second layer is around the addressable market and the category. And look, this is a tricky one. There's a very famous quote about VC about the first time people looked at Airbnb, they're like, okay, this is nobody, because who the heck is going to rent? How big is the market of people renting their couches? Non-existent, right? So, a total addressable market is notoriously hard, but particularly the types of companies that you have in your organization that are a lot of consumer products, how big is the baby market? How big is the books market? How, what are the trends? Is it growing? Is it declining? Is there a specific niche that's completely underserved? I think those types of conversations, helping investors understand that this is a big opportunity and how it grows from there, very, very important. Because again, investors are going back to that equation in the back of their head. It's like, can this company 3X? And so if you're looking at a market that's, a $50 million market, it's just never going to be, it might be a very good business for you as a founder. You might be making $10 million a year, and you know what? Amazing. You have great margins.
The market cap is X, and it's not enough.
It's not enough. So I think the category is the third part. And then the sort of, so team, category size, market dynamics, are they in a dying category, in a growing category? For example, post-COVID, there's so many trends that I see that I know are going to continue in terms of e-commerce, in terms of health and wellness, in terms of kind of conscious consumption, right? Are they tapping into those trends that the investor may have in their thesis? And then the third piece of it is traction. So I think pre-revenue is really tough to get funding. Unless it's like friends and family and angels, unless it's something where you're coming from an industry and you have such credibility in that industry that people are willing to sort of bet on your knowledge on who you are. I think, personally, I prefer to do seed than pre-seed, which is the pre-revenue side. But the only times I've seen pre-seed is, it has to be somebody who's got a really well thought out plan.
Came off a big acquisition. Came off a big acquisition from another project they started, has a reputation for being successful.
And has a really good plan of how you're going to test this and validate this. And, because the problem with that pre-seed, pre-revenue is, as an investor, what I'm terrified about is what if you, Chris, start a yoga mat subscription and 3 months in, you're like, forget this.
I don't want to do this.
No, I don't want to do this. And I just $1,000 of my fund's money, and now I have to write it off. Right. So it's very, very risky. Once you start to have some traction, the number, a lot of the metrics are the metrics that we've discussed. So cost of acquisition channels, right? I think that more and more investors want to see alternative acquisition channels that are not all paid social, right? If you're 90% Facebook, we all know the algorithm changes all the time. The prices go up and down. It's a very risky proposition for venture. So what else are you doing? How do you have any secret sauce, any special way? They're looking at retention and LTV, super important. And this is tricky. I remember in the early days of Scentbird, we would get all these questions about LTV and retention. We're like, well, we've been in business for 6 years. How do I know what the lifetime value is, right? I think that's always the honest answer is, look, your LTV is going to be your best guess when you haven't been in business for a few years, right? That's sort of a chicken and the egg, but at least have a very well thought out, build the best model you can to convince an investor that and you understand your customer. Retention is key for subscription businesses, right? Because it's sort of the other side of the coin with CAC, right? If you say, well, I can be a little bit more lenient on the CAC because my retention is sub 10%, sub 5%, that's super, super important. I also think that another metric that investors look at is the power of the community, the virality, do people really love this? Do people rave about it and tell their friends? That's super, super important.
Yeah.
And then the final thing I would say is unit economics, right? Does this business make sense? At the end of the day, can you make money? Because even if what are your margins? What are your expectations? Things that I see a lot when I look at sort of first-time founders is just insanely optimistic expectations regarding economies of scale. Maybe when you go from 1,000 units to 5,000 units, you might be able to cut $1 of costs. But when I see people that are like, well, but when I go from 5 to 10, it's going to be, 1/8 of the cost. No, it's not.
Yeah. Well, I mean, the reality of it is you can figure that out, right? Like you could talk to the manufacturer and say, well, if I ordered 10,000 units instead of 3,000 units, what's the cost? And you can really actually just identify that number.
Yeah.
I like how you brought up.
Yeah, and the shipping cost is the biggest one, right? Like we all live and breathe, die by these darn shipping costs, and those don't change that much at scale, actually.
No, and if anything, they go up every year, right? Exactly. So it's like you got to battle against that. What I like that you discuss, and I talk about this a lot, is you have to have diversified top of the funnel traffic, because, like you said, one algorithm change in Facebook, one like demographic campaign that goes stale that was performing at a high performance rate. Like goes stale, like now all of a sudden you're like grasping for new target audiences. So that makes a lot of sense. No, that's really good. It's really good to know. And I figured it was a lot of those metrics that made sense. And I know that the team's very important. What do you think about like brands that want to do this? Like, what would you say for them is like, do you feel like brands that are entrepreneurs that have also put skin in the game, like they put up some of their own money and now they're looking for more, right? Because that's got to be important, because if somebody's not putting up any of their own money and they want to go like take 10 million from you, and then it's like you said, what if they just give up after, like you're at their, like how do you do that? How do you think about that?
So, it's really interesting because it's tough for founders, because a lot of times they will put, their own money, their own savings. And on the one hand, I think VCs value it because that's how you get this far. That's how your business is worth what it's worth. On the other hand, your dollars and the dollars that the VC puts in don't get valued the same way.
Yeah.
Do you know what I mean? So it's sort of like, when you come pitch me, I'm going to figure out what the company's worth. And if I think the company's worth 10 million, I don't really care if you put in 8 million or 5 million. I still think because of my value of because you're selling X, Y, and Z and you have X, Y, and Z margins, this is what I think it's worth. Yeah. So I think that's hard for founders to sort of swallow, but it's sort of the reality of how venture values companies.
How do most of these VC firms see their return? Are they waiting for an acquisition? Are they waiting till profitability? Did they take quarterly check? How do they typically look at it, right? Because also, like, I keep thinking about little things, right? If I'm investing in a few startups and I have, and it's like, well, we got to make sure that the founder doesn't all of a sudden give himself $1 million a year salary and like there's no profits, and right, like, how are you right? How are you looking at that, and where do you see your payout when it gets acquired, or how do you look for it?
So, first of all, on the $1 million payout, again, this is one of the reasons why, as a VC, I get a seat on the board. And one of the most common clauses on the funding agreement is that I, as the VC, I'm going to have to approve your salary.
Yep.
So the founders, again, part of what you're going to have to get comfortable with is probably your board will have to approve your salary. So you can't just pay yourself anything.
Yep.
So in terms of how a VC gets their exit, it's usually through acquisition. It's usually through an IPO, and now SPACs. I mean, BarkBox being an example. So the good news is I think there's a ton of activity right now, and investors are seeing on the consumer side, there are so many acquisitions back and forth. There are SPACs going on. So it's a good time for consumer and consumer subscriptions, because I think there are more exits than ever before. It doesn't only have to be an IPO.
Yeah. So before we get off here, because we're coming close on time, we know that trying to raise money can be very time consuming. I knew early stage Gentleman's Box. I went to the Valley. I pitched like 7 companies. I also did it because I wanted to learn more about that like world. So I was like learning what they were looking for.
Yeah.
And we almost did a deal with one brand that we didn't do it, and it was okay. But like, I think that one, it's probably being self-aware about like whether your brand should even be trying to launch, like you mentioned. But what's one tip? Give me one thing that they need to think about and consider if they're going to pitch to some VCs. Give me something a tip that you think is really good when they're trying to pitch, whether it be knowing certain metrics or whatever you think, or what do you look for right off the rip?
So I would say, first of all, know yourself and what you want out of this. So that's where I was going, as like VC is not the only avenue and not the only way to grow. So be super honest with yourself of what is right for your business. Know your numbers. If you're going to go out there, know your CAC, know your, as I said, part of a VC, it's like, I know that I'm 100% sure that all your numbers will be somewhat wrong, but I want to make sure that we've gone through the process and thought through these. So that's super important. And I would say the other part is like work on your pitch. Like it really, the deck matters. Be succinct. My favorite is like 10 slides, maybe 15, few words. You're going to be there to present it. Make it really visual. Make it really easy to grasp what on earth you are. Understand that, VCs are seeing tens and thousands of decks. So like things that make me really quickly understand what the heck you're doing, that's super important.
Yeah.
And I would say, reach out to anybody you can and get feedback even before you pitch. So that when you're actually, one of the strategies that a lot of early stage startups do is like make a list of like your B play, like not the person you absolutely want, but the people that are like good but not the best, and do a couple of dry runs with those guys before you hit the most important investor. Because you do get better at it. You learn the types of questions you're going to get. You learn what are the weak spots of your pitch, and you get better at it.
Love it. Rachel, thanks so much for being on with me today and taking time out of your day. For all these that watch, thank you for joining. I'm on every Friday. I'm also on every Tuesday. If you have any questions post watching this video, please feel free to put them in the comments. Rachel and I will try to check it out and answer them if we can. And Rachel, enjoy the weather there in Costa Rica, and I will talk to you soon.
Thank you very much. It was great to chat.